Welcome to the Daily Brief, where we'll go over the action in the market for Wednesday, December 21st. Happy first day of winter. And then we'll see how things look for Thursday, December 22nd. We did see a bounce. Is this enough to really turn things back more positive? Not yet. We kind of have to treat this as more of a dead cat bounce. But if we see follow through buying, that could switch things back more positive. So there's a glimmer of hope that we might be turning back in a more positive stance, but we still have to go with the negative stance overall. A lot of our short-term oversold condition did get worked off in Wednesday's session. We'll have to see, can that continue? So let's go back and talk about what happened. Right at the open, we had a higher open above R1 at 38.41. We then went above R2 at 38.61. We hit resistance at 38.90, which is it's a little bit above where the 50-period moving average for the S&P 500 is at, and that might be acting as overhead resistance. As the day went on, prices drifted sideways, and we retested 38.90 again, but we were not able to break through that. Going into the close, we were off of the high slightly, but we ended up being up 1.49%, but volume is it's dropping. It's below average and declining even more. So that might be a bit of a warning sign to see an update on a decrease in volume. The technicals are still negative overall, but as I said, we're working off some of this oversold condition. Inflation and interest rates, that's still the real fixation of the markets for right now. So let's go back and talk about what happened. And a lot of the positive backdrop came overnight. The futures were up about 1%. Even before the stock market opened. So that really helped the backdrop. And it gave us this gap right here where we went above R1. We quickly got above R2, and then we came right up to this 38.90 level. We hit that 2 times before falling back a little bit and closing off of the high. So what are some comments that we can make? The S&P has bounced after testing 3,800 back in Tuesday's session, and it regained the 50-period moving average, about 38.77 in Wednesday's session. We'll have to see, can that hold for right now? And there's also this renewed hope that there might be a Santa Claus rally going into the end of the year. That is kind of what the market's hanging on right now. What helped in Wednesday's session was Nike and FedEx. They came out with earnings reports that were quite well received. There's also another huge spike in the equity put call ratio on an up day, which usually that falls on an up day. Well, it went up on an up day. And the VIX is not really participating. It's not showing a lot of fear right now, so that we're keeping an eye on that one. The COVID cases in China continue to spread, and the market is still, at least the last few days, they were worried about this earnings per share on a company by company basis, and then the valuation concerns with the market as a whole. The dollar was up, which that sometimes provides a headwind to stocks. Well, it didn't really do that in Wednesday's session. What did help is that interest rates were down slightly. And on a short-term basis, I had a whole list over here when I did yesterday's video. A lot of those indicators have been worked off. So we still have some PMO studies that are extreme negative, as well as some of our stochastics, and I'll show you charts of those. We had the CCI 14 and 20 being extreme negative. After Wednesday's advance, we have only the CCI 20, and that's it. We're not really seeing anything else giving us an extreme negative reading in the intermediate term. We still have our yield curves that are inverted, the same ones that have been inverted for quite some time. Sentiment is still over in the fear area. Now, we really pay attention to this when we get extreme positive or extreme negative. When we're more in the middle, we're in the greed side, that's more positive. When we're in the fear side, that's more negative. We tend to go with that. We don't really go against it until it gets extreme. Well, we're kind of going with that still, and sentiment hasn't really changed from where it was. As far as the economic reports, we had the weekly MBA mortgage applications index. It came out at being up 0.9%. Refinancing applications were up 6%, and purchase applications were down 0.1%. The current account balance, it was a little bit better than expected. They thought it was going to come in at a negative 224 billion. It came in at just a mere 217.1 billion. The last time we had this report, it was at a negative 238.7. Existing home sales, we're still seeing follow-through weakness in the housing market. The home sales were down 7.7% on a month-over-month basis. On a seasonally adjusted annual rate, SAAR, that came in at 4.09. They expected it to be at 4.20. So that was weaker than expected and really dropped from the last time we saw this at 4.43 million. And this is the 10th month in a row that we've seen declines. Total sales were down 35.4% from a year ago. So this is just more weakness. As interest rates go up, as inflation is really impacting folks, they're finding it not as wonderful to go out and buy a new house or refinance their house. Consumer confidence, this was actually better than expected. It came in at 108.3. They expected it to be in at 101. The last time we got this, it was at 101.4. So that is just showing that somewhere along the line, people are feeling a little bit better about things. Our trend is still negative and weakening because we're bouncing right now. We're below 20 and we're below the moving average. Our bias is positive though with the up day. And I've switched our momentum to mixed because this could easily switch back into a negative momentum. But if we see some follow through action, that could turn things back a little more positive. Here is the model that we're looking at from 2006 through 2008 that is suggesting that we might see some weakness going forward from here, especially into the end of the year. We could break away from this at any time. That doesn't mean that we're magically always going to stick with this, but so far it has been hanging on to this rather closely. The one thing that we're not seeing is a lot of action in the VIX. When we were declining, the VIX didn't go up, it actually declined, and we're getting more to a complacent reading with the VIX right now. But if we really start to fall, we would expect to see the VIX climb. This is a fear gauge until we get to kind of an extreme reading, but we're far away from that currently. On a one-day basis, we probably overdid it based on the advanced decline ratio. We went up a little too far, too fast. We were extreme positive with that. And here's the VIX showing that we're getting back down to this 20 level. We're just slightly above it right now. Usually this is the upper end of extreme. So if we drop down below this, we're getting more into a, not a complacent, but more of a neutral stance as far as the VIX is concerned. And then I'm also bringing up another chart that shows us a little bit different way of looking at the VIX. This takes a ratio of the VIX to the S&P, and we see where this is really starting to spike up. We're going to have to see other times where you see the red lines here, and then what did the S&P do after that? A lot of times it led to a decline. So if this gets a lot higher, spikes, and then starts to come back down, that could signal some kind of a short-term top in the S&P, possibly even intermediate term. Here's the Ulcer Index, which is also a measurement of fear, showing that it continues to increase as we've been coming down with the S&P 500. And here's the crazy reading for the equity put call ratio. It's just to the moon right now. We haven't seen this bigger reading in a long time. And this just suggests that a lot of people are really loading up on the puts. They're buying a lot more puts than there are calls because there's some fear in the market. Even though we're not seeing that in the VIX, we are seeing it with this indicator. And then here's the 5 period where we have another spike. We just blew out this other spike that we had been working off of, and we're getting a good reading. When we really start to pay attention to this is if we get a real high reading and then it starts to come down, a lot of times that will give support to the S&P to go higher. But we're really not seeing any follow through with that yet. And this is just a longer term look at that same chart. This is the highest reading that we've had going back a number of years in this chart. So that's kind of a weird phenomenon that's happening right now, which often will mark a bottom in the market. But we have to see follow through with price before we really latch on to this. And we're not seeing really any of our other charts, our setups and our rotation. We're not, they're not necessarily confirming what we're seeing here. Here's our trend showing that we continue to decline with the ADX. It's below the moving average and declining. The red line is on top, even though it's declining. So we default to the negative side. but we really want to see this turn back up if some kind of a trend is going to develop, but it's just not happening yet. Here's the BPI on an update. It continues to decline. We're working off of this extreme positive reading, which a lot of times marked a top in the S&P. Will that continue to be the case going forward from here? We had been extreme negative with the PMOs that are rising. Looking at our PMO study chart, we're back, not giving an extreme reading, but we're coming off of that reading. We're still extreme negative with the number of buy signals, but that could be starting to turn back up, and we're still declining with the PMOs that are above zero. Here's the stochastic chart where in the short term, we've worked that off, but we're still intermediate term. Again, remember, this is intermediate term in the context of the short term. This just subdivides the short term time frame. It's turning back up, but it's still extreme negative, where our longer term chart is still declining. Our moving average study, we had gotten extreme negative with the 20 period, but now we're no longer there. We've turned back up with the 50 and the 200. So this situation has been worked off now. McClellan oscillator, after giving an extreme negative reading, has now bounced back up and is not giving an extreme reading any longer, but it's still below zero. We'll want to see this cross above zero for it to turn more positive. Our double and exponential my goodness, why do I have trouble saying this? Our double and triple exponential moving averages, we're getting right back above slightly this anchored moving average going back to the COVID low. That's somewhat positive right now. Can it continue? Here's our daily chart showing that we came right back up to the 50 period moving average, which may be providing some overhead resistance. Even though we're slightly above that right now, we were able to bounce up off of the S1 level here, so that's positive. Can this continue and move more to the upside, or is this just wearing off the oversold condition before we get set to go down even more? Here's our moving average tree, again showing that we're just slightly above the 50 period moving average. New highs, new lows. We saw a little bit of an advance in new highs and a contraction in new lows. It's still negative, but it is showing some improvement with our 5-day, and we're pretty much flat with our 10-day. The Elder Impulse system has switched back to neutral, where we had been positive with the green bars. When we saw the downward movement, that switched to red. Now, as we're going back up, we're back to neutral. Here's the Ichimoku cloud. I just call it the itchy cloud, like itchy and scratchy. But the reason I bring this up is sometimes this will provide support, where we came right down to this level, which was at about 3,800, and have been bouncing up off of that. Are we going to continue to bounce up higher, or will we eventually drop down below this green cloud and turn things more negative? Here's our fib retracements in the short term, where we're right at this blue line here, which is at about the 38.78 level or so, right about where current price is, just a little bit above where we're at. So that could be providing some overhead resistance. And longer term, we were able to get back above this double fib retracement level at the 36.26 level. Can we stay above that and continue to advance, or are we going to fall back down? The weekly chart also, we're still hanging out above this 38.2% retracement. So that's positive. Are we going to lose that, or are we going to bounce up off of that? And we're still well above the 200-week moving average. As long as we stay above that, that gives some hope to the market. If we break down and go below this moving average, we're really going to turn more decidedly negative. Here's our trend channel. We're kind of dancing around the midpoint of the trend channel. And the Dow, it's still above both of the moving averages. So here's the golden cross. As long as price stays above both of these lines, this golden cross will continue to look valid. If we break down below and close below these moving averages, that'll turn things more negative and possibly be a fake out. And I just wanted to bring this up. This is looking internationally so far for the week, where our interest rates, the one I wanted to show you is I talked a little bit about Japan in yesterday's video, where they've been anywhere from 0 to 0.25 with their range. Well, it really spiked up because the Japanese central bank said, okay, we can raise this to 0.5 instead of 0.25. And that just means they're experiencing a little more inflation in Japan. And so they're widening how high the interest rates can be to hopefully get a handle on the inflation that they're seeing. But this could easily develop into a really negative situation going forward. And that's why for the last number of months, I've been keeping an eye on that, not really talking about it in every video, but just watching it to see, is that eventually going to feed over into the Japanese market if things turn much more negative, and then eventually feed into the global markets as well as the S&P 500. So what's our outlook then for Thursday? The technicals are negative, but they might be improving. How's that for decisive? We don't really know yet. We just kind of have to treat this as a dead cat bounce until we see more confirmation the price wants to go up from here. But we don't really know at this point. We have the third quarter GDP estimate coming out. That may not be that big of a deal because we've already had two readings. That's why they call it the third estimate. If it's really, really different than what we've been seeing, that might impact the market, but otherwise it might be a non-event. We have weekly jobless claims and then the leading economic index. Not really a big day for economic reports. We have all the geopolitical events with inflation and interest rates being the real fixation. And then the situation in Japan, which I talked about a little bit. And any one of these things that are on this list, and even something that's not on this list, just an unforeseen event, could come flying in at any time. So what are our scenarios? Can't really go with the down scenario because we're not trending and we might be improving. We want to see more downside to get that negative side back if you're hoping for more downside movement. We can't really go with the upside because we're still negative overall, although things might be improving. Our scenarios and setups, yeah, they improved a little bit, but especially our rotation, they're still breaking down. They're not really coming to the forefront. We're still seeing this growth versus value, with value really winning out. And the technicals are still negative overall. We're trying to regain some of the moving averages, especially the 50 period, the pivot levels, the fib retracements. Again, we're going to need to see more of that for things to turn more positive. So we're still going with this sideways look at the market with our trend, but the ADX is still weakening. It's below 20 and the red line's on top. Even though that's coming down a bit, we're still negative overall. So our conclusion, the S&P is negative, but it might be improving, but we want to see more follow through. Short term, we're just slightly oversold. A lot of our oversold condition has now been worked off. Intermediate term, we don't really have, other than that one CCI chart, we really don't have anything that's extreme negative, and it could be showing some improvement. Long term, we're still negative because we're below the 200-day simple moving average. So thank you. Have a wonderful Thursday. I'll look things over and then talk to you in the next video after Thursday's session.